So, for the last 6 to 7 months, I have been really focusing on investing by actually understanding the balance sheet of a company. And this has led to a decent profit and returns over a time period. Now, I'm not saying you can buy a Lambo or a Ferrari by doing this. Won't happen only if making money was that easy as they actually show. But you will definitely understand how to invest into good companies. Or tomorrow, if you want to invest into a local business, you will understand how to select a good business by actually learning this. So I wanted to share this with everyone because I know that not everyone has a time and patience to sit through a 3 to 4 hours lecture series to actually understand how the balance sheet works and how to analyze it. So I just thought, why not summarize it for everyone so that you guys can avoid the 4 hour lecture series which I had to watch a couple of months ago. So with that said, let's get into it. So in this video, we will be actually going through the asset section of the balance sheet and understand how to analyze assets within the balance sheet. Now, if you haven't seen the first part, by the way, pause, go watch that and come back to this, as this is just going to make it easier for you to understand this video, as the previous video explains how to read the liability section of the balance sheet, which is pretty much the first half of the balance sheet. So like we previously discussed, whatever a company or a business owns, that's the assets for that company. Now, this can be factories, buildings, cars, computers, and even the furnitures. All these come under the assets. Now, again, I'm going to use a balance sheet of Reliance Industries itself. So, like the liabilities, you have two sections under assets as well. Same logic applies here also, non current assets and current assets. Non current assets are your long term assets, which will remain with the company for more than 1 year, and the company cannot convert these into cash on priority basis. Current assets are your short term assets, which are kept for less than 1 year. So let's go through non current assets first. The first title under non current asset is tangible assets. Tangible assets are anything which you can see and touch. Now, this includes land, plot, offices, factories, which the company owns, vehicles, office equipments, and even the furniture. Now, the company has to make a balance sheet on a regular basis. If a company buys a truck today for 10 lakh, it will be an asset today for 10 lakh, but the next year, obviously, it won't be worth 10 lakh. Not just next year, what about the year after that? Or 10 years down the line? Every year, the value of the truck or the machine will drop because it's becoming older and new technologies are coming up in the market. So, the older a product becomes, the more value it loses. So, this whole concept is called depreciation. Now, depreciation is applicable to all assets except land or plot of the business, simply because the land doesn't depreciate in value. Land's value increases over time. So, if a company bought a piece of land for 50 lakh 20 years ago, it will be worth way higher, but on the balance sheet, it will still show as 50 lakh itself. Next is intangible assets. It's simply the opposite of tangible assets. So, anything which you cannot touch or anything which you cannot convert into cash, those are your intangible assets. Example, computer software, trademark of a name, various business models, or patents. Next would be your capital work in progress. So these are tangible assets like factories, offices, etc., but they're still in work in progress when the balance sheet is being created. Once they finish, it will be shifted to tangible asset section. So these three put together are known as your fixed assets, since these are long-term assets and the company can't really convert them into cash quickly. Next is non-current investments. So anything which has been invested by the company for long term, like bonds, stocks, mutual funds, with a timeline of more than 1 year, and these are your non current investments. If this amount is a big amount, then you need to check a little bit more to understand where the company actually has invested in and what kind of risk is the company taking with the excess cash. Next would be deferred tax assets. It's pretty much the opposite of deferred tax liabilities. Let's say company ABC bought a car for 10 lakh rupees. Company says there's a 20% depreciation, which is of 2 lakh rupees. But as per the income tax, the depreciation is 15%, which is 1.5 lakh. So if you see the difference, that's 50,000 rupees. So if this amount is positive, it comes under assets. And if it is negative, then that means the company owes this amount as tax and it will come under liabilities. Moving on, we have long term loans. Quite simple and self explanatory. Pretty much loans which the company has given out and will get back the money in future. So that's pretty much everything in the non-current asset section. Moving on, next we have the last part of the balance sheet, which is the current assets. So like I said before, these are your short-term assets, which are for less than 1 year. These can be converted into cash within a short span. First title you have in this section is current investments. This includes all the short-term investments which the company has made. It's as simple as that. Next would be inventory. Now the company has three types of inventory. Raw material inventory, where the company gets all the raw products, work in progress inventory, when the product is still under making, and finished good inventory, which is when your product is completely done. So everything put together comes under the inventory section. Next would be trade receivables. This is just the opposite of trade payables on the liability section. Receivables means when the company has provided its material to the vendors on credit and is yet to get paid. Like we discussed in the previous video, companies normally sell products to vendors when they sell on credit basis, where the vendors pay them within a 30 to 90 days. So that pending amount which is yet to be received by the company will be the trade receivables. Next would be your cash. Pretty much the cash which the company has with them right now and the assets which can be converted into cash on a priority basis. Last would be short term loans, which is pretty much any loan which the company has given out for short term basis and is expecting the money to come in within the next 1 year period. Now, practically speaking, you can just understand this whole process in a cycle itself. First, with the cash, you buy the raw materials. The raw materials, when worked upon, becomes your work in progress inventory. And then finally, once it's finished, it becomes finished good inventory. Then it's sold to the vendors on credit basis, where it becomes trade receivables. Finally, the vendor gives the cash and you buy the raw materials again. Simple logic. So, with that said, you guys, thank you for watching this. I really appreciate it. I really hope you did understand how to read and analyze a balance sheet from this particular series. And if you did understand, then make sure that you hit the like button and subscribe as well if you haven't already. I would really appreciate all the support. Also, if there's any particular questions regarding this topic, feel free to comment them below or just drop me a message on my Instagram or LinkedIn and I'll try to get back to you as soon as possible. So, with that said, see you all in the next video.